US investors cheer tariff certainty, Indian economy may not be as resilient as data suggests, and why Home Depot still fails to impress me. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode. We are on episode 135 of the Stock Doctor podcast. I mean, if you really look at it, I mean, I'm glad that I'm back for 2 weeks in a row now, and hopefully there is not much breaks. We can continue with the show, but we can continue with the show week in, week out. So now there is some continuity, which I'm really happy about. Now, when it comes to stock markets, when it comes to the US markets, apparently there's nothing stopping the market momentum these days. Every time some negative news comes up, the markets drop, the dip seems to get bought, and there always seems to be some positive news or some positive developments taking place. Either that or the markets seem to adjust to a new reality, one that is driven by President Trump and his tariff policies, that's exactly what's happening, right? I mean, last week was no different as positive trade developments and some solid earnings numbers from the likes of Google parent Alphabet took the S&P 500 to get this, a 14th record close for the year. All said and done, all three indices firmly ended in the green. The Dow up 1.3%. S&P 500, like I said, closing at yet another record, up 1.5%, while the tech-heavy NASDAQ just continues to zoom in, ending the week up 1%. So let's kick off the first segment, Doctor's Weekly Snapshot, without wasting much time, with the biggest development of the week, one that's really got the markets pumped, excited, insert whatever adjective you need. And that is the two mega trade deals announced between the US and Japan and the US and the European Union. Now, the US-EU deal is a massive one, in my opinion, given that EU is, when you combine together the 27-country bloc, EU is the US's biggest trading partner. Having said that, do not discount. Investors shouldn't discount the US-Japanese trade deal, especially if you're an auto investor, shouldn't discount it at all, because Japan may not be the biggest, but it's certainly one of the US's key trading partners. And when it comes to automotive, when it comes to autos, Japan is one of the biggest. In fact, you also know the fact that Nippon Steel has bought US Steel, and essentially, so Japan has a lot of role to play in the US. So while EU is the biggest trading partner together, 27 countries, this is one country, Japan. It is so, and by no means is that deal any less important. Now, I'm not going to delve into the minutiae of each of the deals, but let me give you a brief overview of each of the trade deals. Now, let's start with US-Japan. The US and Japan have agreed on a 15% tariff on most goods traded between them, including a cut on Japanese auto tariffs. And that's why I said, if you are an auto investor, this deal is very important for you, especially if you invest in auto stocks, especially if you invest in overseas auto stocks, whatever be the case. Japanese auto tariffs have been slashed from the 25%, which is applicable across the world, to 15%. Now, here's the striking part. There is a significant development here when it comes to US-Japan trade deal, and that is, there is going to be a $550 billion investment fund that is going to be financed by Japanese banks or institutions. This is, I mean, I'm not an economist, but I don't think I've ever read in my limited experience as an investor in the markets, US and Indian markets, in nearly 6 years been doing it. 7 years been doing it. But in that, I've never heard a trade deal where a country just gives 550 billion or whatever, even 100 million for that matter. So Japan is actually creating a new 550 billion with a B, investment fund to be financed by Japanese bank institutions. And get this, here's the catch. The US, not Japan. So money is from Japan, yeah, but the US would select and control which US infrastructure and strategic projects are funded. Here's the more surprising element. Normally, what happens when you put in the money? When you're an investor, what happens to money? You expect some returns, the profits are yours to keep, right? Now, have you ever heard a case where an investor puts money in it and you get to keep the profits? That's exactly what's happening here. $550 billion invested by Japanese banks and institutions, but 90% of the profits of those investments go to the US taxpayer, 10% to Japan. It's as weird as it sounds, but It's a deal. Now, obviously, one has to know that these are all verbal agreements so far. Nothing's put in paper. Until something's put in paper, we cannot be really sure how the structure goes. But it's a very, very weird development as far as I'm concerned. I've never heard anyone, if I were to invest in a company, I would expect the returns all to, proportionate to my investment. I wouldn't say, oh, you know what, XYZ, a company XYZ, keep 90% of the profits, but you'll still have my money. It is extremely insane, and it is a bit of weird as far as I'm concerned. Now, as for the EU, 15% tariff will apply to the vast majority of EU exports to the US, including high-profile sectors such as cars, semiconductors, and pharmaceuticals. The rate replaces the earlier fragmented systems where different products faced varying and cumulative tariffs. The EU also committed to purchasing 750 billion in US energy products and to make an additional 600 billion investment in the US, although this time it is not a fund. Yeah, the EU doesn't get. I don't know. It's not, nothing is written, but from what I've read and what is on the verbal agreement, the US doesn't keep 90% of the profits of the 600 billion investment, unlike Japanese deal. But the EU still will invest 600 billion investment in the US. Okay. The bloc also promised better market access to US firms, and finally some strategic sectors such as aircraft and related parts, certain chemicals, semiconductor equipment, and select agricultural products will have 0 for 0 tariffs, which is amazing, which is insane. Like, I mean, President Trump is really reshaping this entire global trade. That's all I can say. Love him, hate him, whatever you want. Again, not a political show, but this entire trading landscape that we used to live in pre-Trump era, this is a whole different. It's a very, very monumental moment, I have to say. Whether it's good or not, only time will tell. Now, if one looks at both these trade deals, then one thing is clear: the tariff-free era for US's trading partners is over. Okay, that's what I mean. That President Trump is really reshaping it. Given that, as I mentioned, Japan and the EU are significant trading partners for US, so the 15% regime is likely to be applied to the US's other trading partners at a minimum. Now, keep in mind, Vietnam and Indonesia had higher rates. And okay, you can say the UK received a lower rate of 10%, but the trading dynamics between the UK and US is different. US is actually a trading surplus with the UK. Okay, and so it's very different from the likes of EU, Japan, and even India, which is in the process of making its own trade deals, right? Own trade deal. Now, the good news about the 15% tariff regime is that the uncertainty surrounding the tariffs is gone. And markets in the US consumers can heave a sigh of relief that the tariffs are not as high as initially predicted. Remember the weird reciprocal tariff figures: 52% for in Vietnam, 145% for China, 50% for EU, and then you have 25% auto tariffs, 50% steel tariffs. I don't know, 150% on some other nation. Antarctica gets, even the penguins get 30%, whatever it is. So nothing of that is happening here. 15% regime, even though it's high, at least the uncertainty is gone. Now, I've told you time and time again on the show, markets hate uncertainty. So the 15%, don't get me wrong, is no small figure. But from a market's perspective, they would rather swallow the 15% than swallow the uncertainty surrounding the tariff rate and the tariff policy in the global, and whether there's going to be a trade war or not. Okay. Now, the US, I've told you this, I'm telling you again, the US and President Trump specifically is certainly reshaping certainly shaping a new playbook for future international trade negotiations. But the rapid manner in which these trade deals with Japan and EU were wrapped up does increase the odds that more deals will be done and dusted in the coming days and weeks. Speaking of clarity, now that's on the trade war, but there was more clarity in the markets front for other areas as well. Speaking of clarity, there was more clarity in another area that has been giving the markets quite a lot of headache. And that's the whole drama surrounding Fed Chair Jerome Powell and President Trump's attempts to get rid of him. This drama was also put to bed when President Trump finally publicly stated that he does not intend to fire Chair Powell, signaling a de-escalation, but making clear that he does expect rate cuts soon. The drama threatened to escalate when President Trump staged an unusual and highly publicized visit to the Federal Reserve's Washington headquarters construction site, accompanied by Fed Chair Jerome Powell, to spotlight criticism over the central bank's $2.5 billion worth of renovation costs. Now, there was obviously some on-camera squabbling between both the Fed chair and the president. Hilarious to watch, not so cool from an investor perspective because, again, creates uncertainty, creates drama unnecessarily, but it served a much broader political purpose, amplifying President Trump's pressure campaign on Chair Powell to cut interest rates ahead of pending Fed policy decisions. However, once again, despite every chance of this drama escalating, President Trump's public statement of not wanting to fire Chair Powell put the drama to bed. I want to say never with this man. So for now, at least, is all I'll say. And all it did was it gave markets more catalyst to keep going higher. Now, on last week's episode, I did tell you the dangers of the Fed losing its independence and why markets are likely to have a negative impact should President Trump fire Chair Powell, and so on. I'm not going to go into that again, but I'm just glad, as a US investor, this drama was swiftly put to bed. Finally, the third catalyst that drove markets to a record close, the big tech earnings from the likes of Alphabet and Tesla. Yes, I do consider Tesla like a tech company. Sue me if you want. It's not an auto company. It's not a traditional auto company. I do consider it as a tech company for sure. Now, while Tesla unfortunately faltered in its earnings, Alphabet, on the other hand, had an absolutely stellar quarter with significant growth both in its search as well as explosive growth for its Google Cloud division. Now, I'll be doing a full Dr. Dissect segment on Alphabet in the coming weeks, but for now, all you got to know is that solid earnings reports from the likes of Alphabet and others also propelled the markets higher. Bottom line, it was quite a busy week for US investors. Don't get me wrong, so much I had to go through to build the transcript for this episode. It was a pretty eventful week, let me put it that way. And it's about to get a whole lot busier next week with the likes of Microsoft, Apple, Meta, and Amazon all reporting their earnings. Excuse me, you still have the Q2 GDP print coming out and the Fed's preferred inflation metric, the PCE data, also coming out. Or just so you know, just to add to the extra drama, on Friday, the jobs report will also be released. So there is a lot happening this week. In addition to that, I do expect more trade deals to happen, especially since the August 1st deadline, which is the new deadline for reciprocal tariffs to go into effect, approaches ever so closer. In the week gone by, though, if there's one takeaway for US investors like you and I, then it's that there is a lot more clarity now compared to the doomsday scenario that was unveiled on April 2nd. We have come a long way ahead. What's also more interesting is that despite the latest surge in global tariff in decades, the world economy and international trade have so far demonstrated surprising resilience. Growth, investment, and trade volumes have held up or even accelerated, defying gloomy forecasts from many economists and business leaders. And this was before the new trade deals that were announced with Japan and EU. And so more and more that will be announced in the days and weeks to come. This would only mean that investors have every right to believe that both the global economy and the US economy will only move higher, given that things have turned out a lot better than what was expected. Having said that, I'm not somebody who's ultra bullish without giving you risk factors. You already know that by now. You've been following me for 135 episodes. So there are still few kinks. There are still risks that investors need to factor in. For instance, Mexico and Canada deals remains unresolved for both these countries, which means the previous threats of much higher tariffs loom. Then, even when there is a lot of positive news coming from the White House regarding the dragon in the room, I'm talking about China, of course, talks are still ongoing with absolutely no clarity in sight yet. The deals with EU and Japan, certainly significant achievements. But for me, unless there is a clear-cut agreement with China in place, there is always the threat of markets' optimism vanishing in the blink of an eye. Next week might be all about the Mag 7. And right now, there's a lot of positivity. But investors, in my opinion, should not forget about the uncertainty that involves the dragon. On that note, let's head to the next segment. The doctor goes home. And welcome to the Doctor Goes Home segment. I'm just going to take a brief pause and sip some water. There's much better climate here today in London, but still humidity seems to be the problem. Temperatures are low, but humidity seems to be a problem. But you and I are here not to talk about the weather. So welcome to the Doctor Goes Home segment. I'm sure you guys must have read about the India-UK FTA finally being signed, the free trade agreement finally being signed by both PM Modi and PM Keir Starmer last week. I've already covered the free trade agreement at an earlier episode in detail, so I'm not going to say much about it. Also, the sign doesn't mean much, to be honest. It's a symbolic gesture, since the free trade agreement will have to be approved by the UK Parliament, and the whole process can take up to a year. So I repeat the same things I've said again and again and again. Waste your time. We got to talk about the current developments, right? No. So what I want to do this week is stay domestic and talk to you about some economic context, some positive, some negative, obviously. I feel like it's the right theme to cover this week, especially since the RBI is expected to meet next week to decide what to do with rate cuts. Right. Let's start with the good news, shall we? Okay, here we go. According to the Reserve Bank of India's July bulletin, India's economy demonstrated resilience during June and July, despite ongoing geopolitical tensions and uncertainties in global tariff policies. More specifically, economic momentum remained positive, supported by promising prospects for the Kharif agricultural season, sustained robust growth in the services sector, and moderate advancement in industrial output. Headline CPI inflation stayed below 4% for the fifth straight month in June, aided by continued deflation in food prices, keeping consumer price pressures in check. The financial system maintained surplus liquidity, which facilitated a much quicker and more effective pass-through of policy rate reductions to credit markets. Finally, India's external sector continued to show strength, benefiting from substantial foreign exchange reserves and a moderate external debt to GDP ratio, enhancing the country's resilience to external shocks. I do have to add a caveat to all this good news that I'm giving you. There's all the positivity that I'm spreading out there. And that is the perspectives of the bulletin is not the official stance of the Reserve Bank of India, but they only reflect the view of the authors of the bulletin, authors of that particular article. Having said that, though, all of these data points that's been mentioned in the bulletin are factual, which means that their opinion makes complete sense. Okay, yeah, I mean, to each their own, yes, but they're basing it on facts. It's not like I think X is because no fact mentioned. No, that it's fully factual. So, there is a lot more strength to it. Now, it also means that if you take a look at this data, then there's no reason why the Reserve Bank of India shouldn't cut rates further, right? I mean, June's inflation data came even below RBI's target, which means for all intent and purposes, the inflation battle looks to be won by now. This was exactly what the Finance Ministry's economic review picked up. More specifically, the review highlighted that while RBI projects headline inflation at 3.4% for the second quarter of FY26, actual inflation, however, was even lower for Q1. The Finance Ministry therefore believes full-year inflation may undershoot the central bank's forecast of 3.7%. It also mentioned that subdued crude oil prices, partly due to an unexpected production increase by OPEC Plus, an extra 548,000 barrels per day in August, are likely to keep inflation in check. At the same time, the review also cited factors that could warrant more rate cuts, and these include sluggish credit growth, which now stands at 10.4% versus 13.9% a year ago, weak private investment, deflationary trends in wholesale prices, and external threats such as global slowdown and the US trade policy uncertainty. This brings me to the bad news. The finance review, that was a great segue done by the finance review to the bad news that I wanted to share, or not the not so good news if you're a glass half full person. I leave it to you, whatever choices you want. Now, according to the June economic review by the Department of Economic Affairs, which was released yesterday, while there is a steady as she goes outlook for the Indian economy for FY26, it highlighted several risks such as external pressures, and by that I mean sluggish global demand, which impacts Indian exports. Uncertainty about US tariffs adds to these challenges, potentially dampening India's trade performance in the near future. So external pressures is one factor. Domestic concerns is the other, the ones I mentioned earlier, the ones I already mentioned earlier. At the same time, the review also highlighted how India is facing medium-term challenges due to significant shifts in global supply chains for semiconductors, rare earths, and magnets, sectors that are vital for advanced industry and technology. Basically, long story short, what the economic review does is it basically underscores that while India has a broadly positive economic outlook, vulnerabilities exist, especially as global supply chain shift and dependence on critical imports like rare earths remain high. Addressing these strategic material dependencies will be essential for sustaining India's growth and maintaining competitiveness. Completely true. Now, in addition to all of this, there are also some other developments that should really worry Indian investors, at least in the near term. The biggest bombshell arrived yesterday when IT giant TCS, Tata Consultancy Services, announced that it's laying off over 12,000 employees. And that's about 2% of the global workforce, marking the biggest mass layoff in the history of Indian IT. What is worrying is that it has nothing to do with AI or productivity, reasons that US giants like Microsoft have been using while announcing their respective layoffs. But rather, the issue seems to be structural. In other words, the layoffs stem from skill mismatches, especially at the middle and senior levels, where employees were unable to transition into newer tech-driven roles despite large-scale reskilling efforts. Now, while this signals a very worrying structural shift in the Indian IT sector, it also leads to the question that investors should really have there in mind. Is this layoff story just limited to the IT sector? Or is this an indication of a broader weakness in the Indian labor market? The other issue that investors have to contend with is that the Q1 earnings have been disappointing so far, which, when you combine with other issues such as ongoing delays in the India-US trade agreement, has led investors, both domestic and foreign, turn pessimistic in the short term. Why wouldn't you, right? While operating profits have been impressive, 18.7% year-over-year growth compared to 14% year-over-year growth same period last year, aggregate sales for leading listed companies grew only modestly or even remained tepid, weighed down by weak demand in sectors such as power, coal, and IT. Now, the drag was particularly pronounced in power due to cooler than expected weather dampening electricity demand, and IT, which hit by global uncertainty and project delays. Now, this surprising twist where you have sales down but operating margins up has added to the overall concern that the Indian economy might be going through a bit of a slowdown. And the reason why I'm saying it is because operating margins are strong, not because of sales growth, but because of factors such as lower input costs and cost efficiency measures. So essentially, Indian consumer is not spending. Companies just managing their expenses better. That's why the margins are going up. So it is a bit of a concern as far as I'm concerned, if you are an Indian investor like me. Now, when you add all this together, the Reserve Bank of India has a major decision to make at its next meeting. Indian economy has demonstrated tremendous resilience, but cracks are indeed starting to form. The TCS news was a shocker. And when you combine with the tepid sales growth for India Inc., along with the uncertainties that continue to persist with the India-US trade talks, India's central bank has to lean towards carrying on with cutting rates, in my opinion. Inflation battle looks to be won, but growth still remains subdued. Resilience doesn't mean everything's fantastic. Look under the hood of the Indian economy, and there appears to be more problems than positives as things stand. Governor Malhotra and company would be wise to take that into consideration between August 4th and August 6th. On that note, let me welcome you to the final segment of the show, the Dr. Dissect segment, where there is going to be another industrial name that is going under the microscope, and that is basically the house building material giant. Getting the words right. House building material giants, Home Depot, ticker symbol HD. So Home Depot had a mixed start to the year when it reported its numbers at the end of May, and with a beat on the top line but a miss on the bottom line. And if you listen to the Q1 earnings call, it is very clear that the company has learned from the likes of Walmart's missteps of linking price increases to tariffs. To give you some more context, Walmart last month became the latest target for President Trump after it announced that it would be raising prices because of higher tariffs. The president on social media reacted to the company's announcement by asking the company to eat tariffs, whatever that means. Now, the development clearly implies that companies risk being the target of President's ire should they directly relate any price increase to tariffs, which would be the natural move to make. Home Depot's management during the earnings call suggested that they don't see broad price increases for their customers going forward. At the same time, they also announced the company is fast-tracking the process of modifying its global sourcing strategy, such that within 12 months, no single country outside the US will represent more than 10% of the company's purchases. Given that the company already sources more than 50% of its purchases in the United States, the move to fast-track sourcing diversification should allow the company to weather any form of tariff storm. And it also lends support to management's strategy of keeping prices intact, which would subsequently allow the company to gain market share in the coming months. Most importantly, however, through this move, Home Depot can shield itself from any attacks from the president, which would be a boost to the company's sentiment. Unfortunately, that is not the problem that Home Depot faces. Okay. Or any such boost, any such shielding, all of that is unlikely to cause any meaningful growth in its business. This is because the fundamental issue that has been plaguing the company remains very intact. A US consumer who is unwilling to spend on big ticket items because of elevated interest and mortgage rates. The latest inflation expectations, as well as a deteriorating sentiment of the consumer, haven't helped the cause either. Yes, consumer sentiment has ticked up recently, but mortgage rates stay the same. Interest rates still stay elevated. That story hasn't changed. Management during their earnings call noted that while there has been a significant increase in smaller home improvement related projects, due to financing requirements for larger projects, the company is yet to see the larger remodeling cycle. This is despite the tepid demand seen in the housing market. Now, all key metrics of Home Depot, I'm talking about US comparable sales, total comparable sales, average ticket prices, customer transactions, all experienced a slowdown in growth in Q1, which suggests that the company could not build on the momentum of the fourth quarter. Now, while the growth rates remain flat to positive for all metrics, bar total comparable sales, the overall trend suggests that the company continues to struggle to gain any traction, which could be attributed to the absence of a remodeling cycle. Management during the earnings call mentioned that they expect the momentum seen in the back half of last year to continue into FY25. To an extent, this momentum can be attributed to the company's professional segment, which continues to show growth with a lot of help from SRS, through which Home Depot has now started to offer a line of credit to customers. SRS is a company that Home Depot acquired last year for 18 billion. So 18 billion is paying off, and that's good to hear if you are a Home Depot investor. Now, in my opinion, unless the larger remodeling cycle picks up, which can only happen once rates start to fall, so-called momentum would remain patchy at the least. The last time I talked about Home Depot, I mentioned how the Fed's policy is what's putting a cap on Home Depot's growth potential. 2 quarters later, story remains the same. Dodging President Trump's ire isn't going to change that. Got a book, got a pen, can only mean one thing: valuation. Now, the company, as mentioned earlier, is expected to see a 2% decline in its adjusted diluted EPS, which is projected to come in at 15.24. So diluted EPS for FY25 is 15.24, okay? Now, that misses my previous estimate of 15.65. But I do believe that management's guidance is a reasonable one, given that the macro backdrop has worsened since the last time I talked to you about the company. And given that there has been absolutely no change to the statement, there has been no change to the status quo regarding the consumer spending on big ticket items. So I've assumed diluted EPS for FY25 at 15.24. According to Seeking Alpha, company currently trades at a forward price to earnings of 25 times, higher than its 5-year average of 22.3. Furthermore, the company continues to be more expensive relative to the peer loaves, although this is in line with its historical trends. Now, given the backdrop, the macro backdrop has now led to a decline in EPS growth for FY25. I've reduced my multiple to 22.3. So forward PE that I have assumed is 22.3. compared to my previous estimate of 26.4. Okay, forward PE 22.3 compared to 26.4. Now, according to Seeking Alpha, the company currently trades at a forward PEG ratio of 5. Okay, significantly higher than the sector median of 1.85 and its own 5-year average of 3.60. Okay, now I'm going to assume 22.3x across the board for all these scenarios, and I'm going to assume 15.24 EPS across all 3 scenarios. Okay. Now, this is the PEG, PE, FY25 EPS. Okay, here we go. So I'm going to make this very easy. So you have the EPS FY25, sorry, you have the PEG, the price to earnings, FY25. You have three scenarios, which is 5, 1.85, and 3.60. Okay, so 1.8, so and across three scenarios, it's 22.3, 22.3, 22.3, then you have 15.24, 15.24, 15.24. Now, that would give you, and obviously, with all this, you can calculate the price target for each, right? So from PEG price to earnings, you get the earnings growth. Add the earning, multiply the 1 plus earnings growth into the FY25 EPS, you get the FY26 EPS. Then take the PE, multiply that with the FY26 projected EPS, you get the price target. So the price target then becomes 355, 381, and 361. Okay, so 355, 381, and 361. So when the PEG ratio is 5, price target is 355. 1.85, 381. 3.6, 361. Take the average, you get 366. And that is my price target. So my PT is $366, which is lower than my previous price target of 413 and represents a downside of about 2.9% from current levels. Now, moreover, the short-term momentum grade of C minus, overall momentum grade of C for Home Depot based on Seeking Alpha's momentum scale, not so very good. So taking all this together, I'm having a hold rating on the stocks. Okay, Home Depot, it's a clear hold for me, and it's 366 is the price target. Now, bottom line, Home Depot had a very mixed start to the year. Top line beat, marginal bottom line miss. Company witnessed slowing growth across all its key metrics, although most of the metrics stayed in positive growth territory. The company's SRS acquisition continues to pay off dividends. Its new customer acquisition channel in the form of line of credit is being developed by Home Depot via SRS. The company also announced it won't be raising prices due to tariffs and is fast-tracking sourcing diversification in order to ensure that it remains well protected from tariff-related uncertainties. Finally, from a valuation perspective, company remains marginally overvalued at current levels and also has weak momentum. So I'm maintaining my hold rating on the stock with an updated price target of 366. Despite some positives from Q1, because the company continues to operate in an environment where the US consumer is dodging the larger remodeling projects, any momentum that the management is projected for FY25 is likely to remain patchy and uneven at best. The company may have dodged President Trump's anger by not raising prices. The Fed and the US consumer continue to spoil its growth potential. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, you know what to do. Do tweet me at Uttam Vinay, UTHAMVINY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I should be seeing you next week. Until then, you know what to do. Stay safe and make some money.